Welcome to TheoTrade. This is Don Kaufman. January 27th, 2023. Just about 30 minutes left inside of your trading week, and it's a rally. Yeah, tell you something that you don't know about this particular marketplace. Listen, throughout the course of this entire week, we're hearing about layoffs, we're hearing about poor earnings, and, well, it's a rally. So let me actually dig right up front into what we're seeing here in terms of price action. So for those of you that actually speak a little bit of option trader geek, I'm going to kick off, of course, the TheoTrade weekend update here with discussion, of course, of what is unequivocally it's a gamma squeeze. What is a gamma squeeze? Well, that's exactly what I'm going to bring you into right now. All right, to geek out on you for just a moment. So here's the SPX, as I term the mother of all products. The SPX was looking for plus or minus approximately $71 move. Thus far, we are outside that $71 move. The moment we actually tagged the upper edge of that expected move, which is right here. And again, when I say right here, let's be incredibly specific. In fact, we're even going to jump to intraday trade. This is an intraday trade. And you can see the upper edge of that expected move at a level of about 40K, 44. Okay. Ultimately, what transpires right here, that level, that 40, 44 is what I would term the happy place for risk. Start to get outside that level and boom. Okay, acceleration, if you will, to the upside. Now, listen, it ain't over. And you can get a gamma squeeze that can reverse on you. But what a gamma squeeze basically amounts to is that you have, for example, retail traders. And if a retail trader goes out and they buy a call, right? You go out and buy 10 contracts of calls. Buying calls is what you would term positive delta. Now, who actually sold you those calls? Market making firms. So the market maker will put that as M right up here, okay? The market maker went out, okay, and sells you those calls. Now, the market maker, of course, then would be negative delta, which implies the market maker doesn't like to take directional risk. So how does the market maker actually neutralize negative delta? They neutralize it by adding positive delta. Where does the market maker find positive delta? By buying S&P futures. So what you start to get into is this monumental kind of gamma squeeze situation where the more calls that you buy, the more the actual market makers have to turn around and buy S&P futures, and we're off to the races. If you want to see it really play out, I'm looking at the SPX right now, but the SPX, it does fuel, some of the gamma squeeze, but a lot of the gamma squeeze, and I want to show you this because I think it's imperative to understand where it's kind of being perpetuated from. The SPX is trading almost 2.5 million contracts, but people, look at the spiders. Okay, it's absolutely spectacular in the spiders. They're doing like 8.6 million contracts right now. Now, granted, the spiders are what? 1/10 the size of the SPX, but that isn't the concern. The reason we're actually seeing these gamma squeezes is, well, right here. I'm actually going to freeze the screen for a second. Look at the volume versus open interest. Open interest is pretty minuscule. So what's actually going on right now is phenomenal. Like all the volume in this business and all the volume in the market is being pushed into the shortest duration option possible. Okay, 0-day expiration options. And a lot of retailer on the buy side, it's a free-for-all. And the market makers have every advantage in here because the gamma is so horrendously fast. Nevertheless, you're in the midst right now of a squeeze to the upside. Does that mean it's going to continue to perpetuate itself? Absolutely not. Throughout the course of this week, you look at the rally and you're like, it's a spectacular rally. To be quite frank with you, right? What has actually transpired is there's nothing spectacular. We hit the upper edge of the expected move, yesterday, right? Which is Thursday, and there was absolutely nothing special about it. When you hit what's expected, it's a standard deviation, you just sit back and go, well, that is exactly what was expected. All of a sudden, though, it's like somebody hit the accelerator, we explode out of it. That's when actually that squeeze comes. And that's pretty much what we're actually seeing into today's close. So that's where I really wanted to kick off the week is, are we seeing anything magnificent? No, but we're definitely in the midst of a type of a gamma squeeze over here. By the way, it's also really apparent inside of the QQQ. If you look at auto expected moves in the Qs, I mean, the Qs are almost like in a 2 sigma move kind of turf. I also, I did catch this, and this does not happen often in the Qs. The volume inside of the Qs on 0-day expiration, it's huge by huge. If you take a look, the Nasdaq options just don't trade like a wild amount, but they're trading today. By the way, don't look like the number of calls versus number of puts. People constantly look at this. They go, the calls are not outpacing the puts. Typically in a product like this, it actually trades 2 times the puts than calls. This is actually a big number of calls that are trading. And again, we're looking at the QQQ over here. Same thing as if you take a look at the SPY. Don't be surprised when the number of calls trading is 4 million on the call side of it. And the put side, you're like, it's only trading 4.5. It's trading more puts. We should go down. Okay, listen. Most of the time, you trade a lot more, like double the number of puts than calls. So the volume in here is it's quite incredible. In fact, if you look at the call sizzle, this is today's option volume versus the previous 5 days option volume. The call sizzle is at 2. The put sizzle is only 1.6. It actually kind of the proof's in the pudding. Looking at that, it's actually telling you exactly what I'm saying is that is a phenomenal number of calls trading. Nevertheless, you're coming into a Friday. Okay, people, look, stuff like this can reverse on a dime. All right, people have to unwind trades and so forth coming into the cash close. And again, you have just about 21 minutes to the bell. Anything can happen in here. I like it. All right, so let me hit a couple of key points. I wanted to bring you into the gamma squeeze. We haven't really had, these gigantic perpetual gamma squeezes since all the way back to 2021. It's the time when people are like, hey, man, look at the meme stocks. Oh boy, here come the guys that are living in the mommy's basement trading GameStop. I get it. It's over, people. It's over. But that was a time of heavy gamma squeezes. All right, so you got layoffs, you got some poor earnings, and you got a rally. There's just no question about it. And the other thing that's actually flipped around on us a little bit is good news. Good news happened to be good again because if you looked at like durable goods, by the way, some of the numbers out there, I don't know how to take this as like good news. Durable goods wasn't bad, but the number itself was absolutely horrific. In the bigger scheme of things, the number was horrific, but it was actually better than expected. Like we were like, oh, this is going to be terrible. And it was better than expected and the market liked it. GDP was better than expected. The market liked it. That's more of a question than anything, because if you see a strong GDP, doesn't that imply that the Fed can come in and be like, oh, let's hit them harder. And then the PCE indicator, PCE showed, a significant slowdown for the most part in consumer spending, which it's a bit catch-22. PCE is one of the preferred indicators of the Fed to gauge inflation. So they're saying, okay, it's going to slow down, but consumer spending is slowing down, which is basically the entire United States economy. But anyway, hey, good news is good again. We've had layoffs, IBM, Dow, SAP. That's predominantly this week. Microsoft, Google, Amazon, Meta. I'm not telling you anything that you do not know, but what I want you to see in this marketplace, and that's the reason I'm picking on this and just threw it into some of my bullets over there. What I want you to be able to see, it's a disconnect. Right? It's just this wild disconnect, fundamentals, technicals, squeezes. Let's bring up NVIDIA. The reason I'm bringing up NVIDIA, in my opinion, my humble opinion, NVIDIA is the absolute pinnacle, if you will, of a squeezing stock at present time. This is a stock that's just, it's on an absolute tear. How much so? By about 43% on a year-to-date basis. Okay, and I do have no qualms in saying this. Okay, I've shorted a number of positions throughout the course of the week. NVIDIA, of course, being one of them. But and again, I've not just gone out and shorted stock. I've actually used defined risk option trades because I'm a little out there, but I'm not going to step in front of the freight train with unlimited risk, right? So NVIDIA, and the reason I wanted to use NVIDIA is here's an underlying that's up again 43%. Okay, that was getting absolutely, look at a 3-year chart, demolished in last year's trade. Okay, at this point, it's just, as far as I'm concerned, this is the quintessential rip your face off rally, nothing more, nothing less. And I've been mentioning this throughout the course of the week, and I've been using NVIDIA, as the, the primary suspect over here. And I want you to see this because I think it's going to be pivotal in the days to come. You realize that Intel, and I even threw this out here, there were some really negative earnings out of Intel. Okay. No rhyme, no reason, no how. Doesn't seem to make a difference. Stock was actually down by 10%. An overnight trade. It's still down, but it's only like 6%. But NVIDIA, obviously involved to some degree. Obviously, it's more, gaming chips, but NVIDIA is actually up again today, up by the tune of about 3.5%. And again, you can get some wild squeezes for a long period of time. If you're actually going to take positions in these, define your risk, people. Step in, use things like in-out spreads to actually curb your risk. But I believe that this is evidence of nothing more than some squeezes to the upside. It's that quintessential rip your face off rally. Nothing more, nothing less. And as I said, there's been some really poor earnings. Like Microsoft, hey, listen, I listened to that. I read the reports. Intel, absolutely horrific. But then on the flip side, you had like American Express. American Express actually is pretty good. Tesla, okay? Tesla, questionable as it is. Some decent earnings out there. Speaking of Tesla, it's worth actually bringing into scope as well. As turns out, Elon Musk is up a couple of $1 billion in the last 5 minutes. Stock's up 65%. Now, the reason I didn't use Tesla as the pivotal stock of being the quintessential rip your face off rally, it's because it did have earnings, and earnings could have actually fueled that. Nevertheless, Tesla also happened to be a bullish position that I had on, which I'll discuss here in a moment. So again, there is a dramatic disconnect between obviously fundamentals and technicals in the present market conditions. And as you guys know, again, I like to speak with my positions, not with just, going through charts and so forth, but my positions, I'm absolutely unequivocally still short this marketplace. And I actually look at it as a little bit more opportunistic, I think, than most do. Okay, look, I've been talking about this to nauseum. That level right there, that level right up there happens to be none other than 42.11. Okay, that's the 42.11. Quite frankly, I'm actually rather surprised we haven't exploded into the 42.11 yet, but the day is young, right? The day is actually not that young, but nevertheless, I'm rather surprised we haven't exploded up to it. This 4100 doesn't really hold a lot of weight in my mind, but you're only a few weeks removed from taking a shot, and it was a huge reversal here all the way up to 4180. The reason I'm actually pointing this out is, look, in my opinion, there's still nothing to see here. Look, I'll even open up a 1-year chart. We're towards the upper end, if you will, but we're still right in kind of the middle of where we have traded for the last year. I mean, we're still in like this humongous volatility, channel. And, even I see, oh, look, this is the lowest fix we've had now in what? Like, look, I got to pull up like a 3-year chart just to make a quick point with this. We're at the lowest volatility, okay, since all the way back into like either early 22 or like late 21. I opened up a bigger chart so you could actually see, though, how low the volatility happened to be at present time. But nevertheless, as volatility is starting to abate, you're like, oh no, it's not a good time to sell premium. On the contrary, the skew is starting to pick up. So a little bit of skew goes a whole long way. Anyway, I wanted you to see the disconnect because at present time, I'm sorry that, I'm actually looking for this rally so I can actually short into it. And I have no problem saying we get all the way back up to 42.11. Bring the pain. I'm short. And I'm rooting for the upside right now because I want to actually step in a few new positions in a few new ways. And I didn't wait, in which I'm going to talk about here because in a minute, I'm going to talk about get your trade on, a couple of profits and losses, a few new trades, though, that I put on. So I wanted you guys to feel the disconnect in earnings. Obviously, this next week is going to be big boy for earnings as well. What's coming this next week? Oh, all of them. You got Apple coming out. That should be exciting. You've got Amazon. You've got Meta. So that's pretty much what's left in the bag of tricks for this next week. But it's big boy tech earnings coming out and coming to a theater near you, of course, throughout the course of the next week of trade. There's another aspect to this as well as, all of this negative news. And, there's a lot of people that go, negative news is priced in. One more that I want to further that with, the negative news is priced in. If the negative news is priced in, then why do you have stock like NVIDIA ripping higher when Intel is screaming about how the PC business sucks? Sorry to be so blatant. Why do you have Blackstone rallying? I actually have a great question here. Why do you have Blackstone rallying? For those of you that don't know this, Blackstone, the media was all over this week and nobody seemed to pay attention, but 7% of their entire asset base is on redemption right now. 7%. I worked in the brokerage industry, okay, for basically 15 years. I never heard of 7%. I didn't even hear of 7% during the financial crisis. That's $5 billion of redemptions. And they've basically frozen out redemptions right now. But it's okay. It's okay. You want to know why? Because Blackstone is on the bid right now. Blackstone's up almost 26%. That's right, people. Now, of course, those of you that are, fans of Blackstone are going to be like, well, it's predominantly in what? It doesn't matter what it predominantly is. It doesn't matter that it's in the REIT category. It's the fact that it's 7% of $73 billion under management. People want it back. Okay. You can create right there a run on the entire market. I mean, that's when we start to get a little bit of a domino effect, start talking about systemic versus systematic risk. Okay, and it's serious. I mean, it's really serious. And I wanted to throw that out because when you start thinking about fundamentals versus technicals and you realize what a gamma squeeze happens to be, the gamma squeeze actually has gripped hold of this marketplace, has nothing to do with fundamentals. All right, of course, this next week of trade. This next week of trade is going to bring something interesting. What's interesting about this next week of trade? Yeah, there's a lot of data points that are going to come out. Let me start with the fact that you have an employment situation coming out on February 3rd. But before that, dun, 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 you get to hear from Jerome Powell yet again. Everybody right now is rooting for a 25 basis point hike, but listen, there could be some surprises in there. So hands and feet inside of the vehicle at all times, because the big question is the Fed actually going to fuel the rally, or are they absolutely going to crush it? I'll tell you right from my perspective, okay, I think we're going to see some big boy volatility. I really do think we're actually going to come up to that 42.11 or get crushed right back to the 39.31. I am actually, okay, I don't mind saying this, I'm leaning a little bit more towards the upside because that's my own bias though, because even though I'm short the market right now, I want us to go up. And I know that sounds crazy. Now I want to take a couple more positions. I want one last hurrah to the upside over here because it's the most anticipated recession in the history of recessions. So in the most anticipated recession in the history of recessions, we're rallying. And you go, that just doesn't make sense. It doesn't have to make sense. Trade never does. Okay, you got to remove yourself from what you think and trade, okay, what you know. And what you know, all right, is there's some volatility in this marketplace. All right, switch gears completely here. Get your trade on this week's profit and losses. One of the first things I did throughout the course of the week, early in the week, I actually covered a ZB for a 50% gain over and done with. The other aspect that I did is I went in and I actually sold some S&P calls, sold some S&P calls, sold some QQQ calls. Okay, I got no problem saying I like to step into this stuff. Okay, when I say I like to step into it, I like to step in and sell premium in the midst of a rally. I like to sell premium in the midst of a sell-off. And to be very, very concise about that, this move in the QQQ, that move, well, take a look. On a year-to-date basis, we're already up about 12%. So I sold some out-of-the-money calls, but I sold calls all the way up here at the 342 level. Okay, so I'm very comfortable in doing so. I sold actually some duration out there, and I'm comfortable doing so because, hey, look, we're already up about 12%. For us to actually hit the 342 level, I don't know about you, but I'm thinking we have to be up about another 15% to get to that particular level. I'd say that trade has about a 97% probability of making 50% or more. That's the probability of profitability, probability, if you will, of making 50% or more, approximately 97.3%. All right. Moving on from there, Catapult. So for those of you that are not aware of what the Catapult happens to be, what we do in Catapult is we actually sell premium often in the S&P options on futures to finance trades. I'm going to show you one here in a moment. But the first trade I wanted to talk about here in the Catapult, this is a trade we just had on. It's in Tesla. What I did inside of Tesla, in fact, I'm going to cruise over to Tesla, okay, and actually bring up a little bit more history. Okay, so bear with me here as I bring up, when I say a little bit more history, let's just go back like the last 60 days in here and see if we've got it. All right, so first of all, I've got a couple of different trades I've done in Tesla. This right here, this was a closing trade in Tesla. I had a bearish trade on Tesla, and it was a home run, okay? The newer trade, though, on Tesla was a bullish trade. So I bought a 150, 160 call spread. 150, 160 call spread. I paid $1.89. Okay, now that entire $1.89 was financed. What was it financed by? The fact that I actually sold, okay, ES calls. I sold calls to finance this. So I paid absolutely nothing for it. The calls that I sold were already opened and closed. I can show you that in just a moment. Anyway, what I paid nothing for made $5.59 and $6.26 respectively. For something I paid nothing for, it's an absolute home run. And that's exactly what we try to achieve inside of this trade. So if you take a look at the Tesla spread, the original Tesla spread was opened on 1227. Taking a quick glance back here, you're going to see some calls sold on 1227. I sold calls for 16. Okay, those are the 44.50 calls. All right, and those 44.50 calls were eventually covered for $7.50. So, okay, we're home. That was a nice trade. That was actually one of the better catapults we've actually seen play out. That is the second catapult that I've hit specifically inside of Tesla. Now, I actually put on a new catapult spread. What's the new catapult spread? The new catapult spread also involved the QQQ. I went out and actually loaded up, and I actually did this in a number of accounts. I went out and loaded up on out of the money put spreads. Okay, so you can see my position here. I'm long the 284, 274. Okay, I think I did this in a couple of accounts here too. Another account over here. Yeah, same Q trade in here. Okay, this is actually in a newer portfolio. Went out and loaded up on some more spreads over here. I actually did it in yet another account on top of that. So I bought a QQQ put spread. That's it. I bought a QQQ put spread, and I bought that put spread 49 days out, and I financed it by selling S&P options on futures. So I got a nice shot, if you will, to the downside of the QQQ financed by the S&Ps. Bring the pain at this point. Again, that's the newest trade I've got in there. Speaking of the newest trade I got in there, take a look. As I said, with these gamma squeezes, this thing can come to a crashing halt. You have 5 minutes left. 5 minutes left to play in the period, and the S&Ps have come off from 41.05 to 40.85. It's a 20 handle move. Again, what a difference a few minutes can make. I told you guys at the beginning of this video that could come off hard and fast, as you actually have to remove positions on a 0-day expiration. People are unwinding crap in here. It's vicious. Speaking of vicious, last but definitely not least, let's come over to the SPX, the mother of all products. So as I started actually here, we were talking about the gamma squeeze, and we're talking about exploding outside of that expected move. Look at this. Okay, so just minutes left to play in the period. Now we're trading closer to 40.70. That upper edge of the expected move is roughly 40.44. Are we outside of it? Yes, unequivocally we are outside the expected move, but not as handsomely as we were just a few minutes ago. So a nice little pullback into today's cash close, and it's not over yet, people. I mean, I've seen some crazy things in 4 minutes of trade. I don't think we're going to fall another 20, 30 handles, but we are definitely outside the edge of the expected move. The reason that I mentioned being outside the expected move, again, that's when markets are almost getting like ripped apart a little bit at the seams, and this is a significant move as such. All right, what are we expecting for next week? So next week carries a lot of data points. We have a Fed announcement, we have an employment situation, we've got earnings, okay? It's Apple, oh my! What are we expecting? And again, I've said this week in and week out, and I want you to understand it in all of the context I can possibly give you around it. Look, we just came off of a week. All right, this past week, we had a $71 expected move. Now here's the kicker. The market rallied, and it rallied big. But now we're actually coming into a week, even after a rally, because everybody's like, the volatility's down, man. But it's really not. The volatility is actually up, because here we are now with a $92 expected move. What gives? Why is the expected move higher? And you go, because there's news coming out. And there is news coming out, but it actually implies more volatility. So with that being said, you now know what to expect for this next week. More volatility. It's one of the thoughts I want to leave you with. You know that there's a massive disconnect right now between fundamentals, what's going on in the ground and what's going on the chart, two totally different worlds. Disconnect yourself with that. Have an understanding, okay? If you're looking for a rally right now, define your risk. If you're looking for just, that the market to flip back around, define your risk. You got to keep your hands and feet inside of the vehicle at all times. What transpired in 2022 is not an anomaly. You're going to be in the midst of volatility for a long period of time. Forget what VIX says. Forget what the VIX says. The VIX ended up down this week. Who cares? Because short-term volatility says the exact opposite. You're coming off a $71 expected move, going into a $92 expected move. Put on your big boy pants. We are gonna move this next week. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.